All right. How do you come off that, Josh? I don't have lights on. I'm just sitting over here acting like I have no idea what I'm doing. It's live at 5, guys. Welcome back. Wow, look at that. Light. Welcome. Let there be light.
I'm lucky. I'm lucky I heard you, Jeb, because I muted that horrific whatever it was that you were torturing us with.
I was over here jamming. I saw you bobbing your head behind the scenes in the green room.
Yeah, that was puking. I was vomiting over here.
All right, guys. Thanks for joining us. As always, we're here to address housing market concerns, questions regarding real estate, questions regarding mortgage financing, refinancing, whatever it is when you're going through the process. Josh Lewis of Buywise Mortgage here with myself to address those questions. I want to get some dirty laundry out of the way here, Josh. And that's that we're not going to be here next week. We're not.
Where are we going? Are we on tour?
We are on tour next week in Yosemite, and I don't want to broadcast from Yosemite. In fact, I don't even know that I'll have an internet connection. So if you have a question, ask it this week because we'll be skipping a week. So if the market collapses next week, you won't have the answer to your question unless you asked it this week. But anyway, Josh, how are you feeling, man? COVID, you won against COVID.
We're COVID free, but the COVID fatigue lingers. So not feeling awesome, but much better than last week.
Could that be age related? The fact that you're pushing upper 40s here, Josh?
I'm in my late 20s, and that's the prime virility age where your immune system just crushes things like this, just spits it out like it's nothing.
Yeah, I see that happening. So anyway, guys, the title of the video this week is the housing market cooling? So if you're watching this video, I know that Michael DeReet is already putting a comment in there with regards to the market in his area of Texas. But let us know what you're seeing in your market, right? That's a common question that a lot of people are asking at the moment. Is the market cooling? Is it, what's happening? And so I'm sure we're going to address that question many, many times today in many different formats. But I'll tell you, as I always do, what's happening in my local market. And again, this has nothing to do with your market, but it's something I continue to update you on. And so you can kind of get an idea of where things are moving, right? So Huntington Beach, where I'm located, we've been around that 160 active properties, 160, 162 last week, I think. And it's been around that number for the last couple of weeks. Today, it pushed upwards of 168, 169. But keep in mind, guys, we had 12 active properties come to the market today. So if those 12 wouldn't have come to the market today, we'd be sitting somewhere in the 150s, which is essentially where we've been. So what I'm seeing is essentially any new inventory coming to the market's being met with demand. And then Orange County as a whole, we've been hovering around 2,500 or so active properties, give or take. Today, when I looked, we were at 2,443. So we were, about 50 under that 2,500. And that's more or less in line with what we've seen over the last couple of weeks when we've been doing these weekly updates. But I'm curious to see what you're seeing in your market. And I can also say on a side note that, every property I'm putting offers in on is multiple offers. And if a property falls out of escrow, when they go back to the market, they're getting multiple offers again. So things are still moving sideways upwards here. We're not really seeing a pullback or any real cooling off at the moment. But anything you want to talk about, Josh, before we dive into this?
Trying to make sure that this battery doesn't die because somehow I did not get my headphones on the charger. So I'm going to have this beautiful orange label here, or
cable
thing hanging out, cable, label, whatever. They rhyme. It's a similar thing. So hopefully that thing.
All right. So
hopefully that takes care of it. What I was going to say, Jeb, in my neighborhood, we talked about it a few weeks ago. House came on the market. I was like, oh, that's a pretty high price, but big yard, pool had been updated and it sold fairly quickly. Neighbors 2 doors down came on the market. House not nearly as nice, but very similar proximity, and thought for sure there's no way they're going to get the price that they wanted, and it sold at that. But where I'm going with that is I'm seeing more homes pop up at prices where you're like, I think the market may push back on this at some point. The homes that are really nice that are coming on the market in our area, they're going to go fast. I'm talking about the homes that are not nice homes, but fairly marginal homes, but coming on at the prices that the really nice homes are coming on. And again, to my surprise, that home that I told you about, it sold. It took probably 4 weeks to go into escrow, but 8 weeks later, sure enough, sold at the price that they were asking. So haven't seen a breaking point. So just it's important when we talk about, is the market slowing? Is it changing? Slowing from what? It's slowing from a really crazy level, and hopefully normalizing where we can count on a little more stable prices.
And I think it's important to know or to read between the lines. When somebody says the market's cooling or that it's slowing, what do they actually mean, right? Do they mean more inventories coming to the market in less demand? Do they mean prices are pulling back? Do they mean where are they going with that statement? Because I feel like I wouldn't say less buyer demand, but less frenziness, if you will, less craziness, but still getting multiple offers on things, still moving. And, people still, going above the asking price in many cases, right? I'm not seeing this, quote unquote cooling or softening that a lot of people are talking about. And as we've discussed, that the active inventory levels haven't really changed. I mean, yeah, they go up. Yeah, they come right back down because properties are going right back into escrow. But I'm sure we're going to talk about this several times throughout the show. But just wanted to start there. But if you're seeing something in the market, let us know. Because again, we're real estate's local. We know what's happening in Southern California. I also know what's happening in some other markets just because I talk to agents in those markets quite often. But there's a lot of you watching in areas that I'm not necessarily updating or getting updates on a regular basis. And it's good to know so that we can pass that information along to others as well. All right. So Got Shonda coming in from Houston. We have Jennifer Lego, who sent me a nice little gift for my kids. So thank you there, Jennifer. Appreciate you being here and moderating the chat. And let's see here. Burn It Up was asking, where is Josh? Well, Josh disappeared because his fancy headphones died.
I think he was concerned about my camouflage shirt. He couldn't see me.
Well, we can see you all right. Well, we won't get into that. Here we go. So Michael's saying that the market's slowing a bit in North Texas. Price points are still high. Multiple offers still given. Homes sitting on the market a little longer. In some cases, the price is dropping a few thousand. Yeah. So, I mean, I could see that happening if you start to get a little bit more inventory, a little less buyer demand. Things might sit a little bit longer. I gave you guys the example of the one that I had set on the market for 25 days or so here in Southern California, which is a lifetime based on, the average days on the market. It actually just closed escrow today for a little bit above where we had originally listed it. So we never reduced the price, took 25 days, but yet we still sold it above the asking price. So give you a little indication there of what's happening in the market.
And the other thing, Jeb, to point out, we're in late August here. We're almost going into September.
Yeah.
So if you see the charts, you and I are Orange County centric because that's the data that is in front of us all the time. But if you look at the charts for Orange County last year and this year, the seasonality didn't really come into play. COVID threw things off, and then the market went nuts and rates dropped, and we don't know what to think about this fall. Normally you would see some additional homes on the market, a little less buyer demand in terms of people out making offers, but so far in our market, we're not seeing that. We're not seeing a bump up in inventory, available inventory, or a decrease in homes going in under contract.
Yeah, and I think I did a podcast today with another YouTuber who, obviously we always talk about. They always ask the same questions, right? And in this particular case, they ask about the market and expectations and what have you. And I do believe that we're going to get back to the seasonality aspect of the market probably this year, right? And what I mean by that is I think you're going to have some sort of slowing down in the fall. Now, is that going to be because affordability? Is that going to be because it's truly the fall and that sort of thing? I think it's going to be a little bit of both. Again, it's me thinking just kind of what I'm feeling in the market and where I see inventory levels go. I don't think you're going to see, inventory levels really increase much further from here because you're heading into the holidays. I don't think you're going to see a lot of people want to list their homes going into the holidays. A lot of people that were going to move or considering moving probably did it and or are trying. You've got those sellers that are wanting to sell their properties, but they're not seeing that inventory come to the market, and I don't think they're likely going to. So those people are probably going to stay put. So I don't know. I mean, it's hard to say, Josh, right? I mean, but I do think during the holidays, especially with the Delta variant, now there's a Lambda variant. Like, I mean, we're going to go down the Greek alphabet here.
Sounds like Revenge of the Nerds.
Yeah, we're going to have a fraternity of variants here shortly, but there are going to be people that are worried about it, that's going to keep some people on the sidelines from selling their house and that sort of thing. So I think it's just going to keep things moving sideways. The real drivers of the market, the supply, the demand, interest rates, the Fed pumping money and buying mortgage-backed security isn't really going to change. So I don't know that you're going to see much of a change overall, but time will tell. All right. So we got Crazy TV asking about any housing market info in San Diego. So San Diego is a lot like Orange County in the sense that it's a desirable area. It was one of the markets that appreciated the most in 2020. I think it was over 20% or something. And the expectation for this year was also some absurd number. So with that said, I don't follow San Diego as closely because it's not my market per se, but it's still a desirable area because of the weather, still has a lack of inventory as a whole. It's going to continue to do what it's been doing, maybe not at the levels that it has been, that 15-20% appreciation, but it's not going to go down until something happens again with supply and demand. And that's going to be across the board, guys. So if you're wondering what's going to happen in your market, until you get some sort of increase in supply, a decrease in demand, a change in the overall market, you're not going to see much of a change. It's just not going to happen.
You know, Jeb, a couple things that we looked at. I sent you this a couple days ago, and there's actually another chart that I wanted to show, but let's just look at this real quick.
Actually, I'm going to go into this on Friday's video in more detail, but I think I know where you're going with this. Yeah.
I'm not sure I got the right screen here. No. Let me just, I'm having an issue with it. So, it was the chart that I sent you a few days ago. Single family housing units completed by decades. When we talk about supply and demand, and there's a lack of available homes, if you go back in the 70s, we built 11 million housing units. In the 80s, 9.8 million housing units. The 90s, 10.7 million housing units. Part of the reason why we had the downturn in 2008, builders went nuts and built 12 million homes, 12.6 million in that decade. Now, in the last decade, although we now have millennials coming to prime home buying age, population in the United States is as big as it's ever been. We only built 6 million new homes last decade. So when you look, another chart that I saw today came out, and what they're showing is that we've seen a downturn in single family housing permits and an upturn in multi-family housing. So when you look at building permits, when the numbers come out every month, they just say, hey, building permits were up 5 or 6%. But then when you dig into the data, it shows single family, multi-family, and 2 to 4 units. They break them out that way. And what we're seeing is builders can build more profitably building multiple unit apartment buildings.
Absolutely.
So we're seeing a lot of that for us around here around Huntington. That's been almost all of our building. Yeah, I can think of one housing development in Huntington Beach that's built in the last 5 years, and I probably think of 10 really nice Class A apartment buildings. So when you look at that, the numbers just tell us that the builders aren't even focused on the problem. They're focused on their profitability. So to us, to people who make their living selling real estate, doing home loans, who talk to people on a day-to-day basis that want to buy a home or they want to know when they should sell their home, we're looking at supply and demand issues. They're not trying to solve the lack of supply issue. They're trying to solve their profitability. What can we build and construct that is most profitable? And at the same time, we've talked about this repeatedly, we have big hedge funds, that something we didn't have 10 years ago, of hedge funds buying single family homes to hold as rentals. So we have an increase in demand, and we have these factors that are pulling supply out of the market. You know, and those things can change over time. The economy can change drastically in 3 to 5 years. And maybe the hedge funds go, hey, this is nuts. We don't want to do this anymore. We want to sell those properties. I don't think that's likely. It's a possibility. But as far as today, they're trying to pull single family housing units out of inventory when we're all hoping for more homes to be available for families to buy at a reasonable price.
No, and you said something important there, Josh, that we don't have a lot of questions right at the moment. So I'm gonna go. We're gonna just talk about this a little bit deeper, go down a rabbit hole, so to speak. So you mentioned hedge funds buying single family homes. Why would a hedge fund, Josh, in your opinion, be loading up on single family homes at the moment?
Because they're chasing yield. There's too much money chasing too few investments. So with the housing, they're getting capital appreciation. So if they buy a $300,000 house and it goes up 5% a year, which it's been more than that, they made 5% on their money. But at the same time, the money was generating a rent yield. That $300,000 property is probably bringing in $1,700, $1,800 a month of rent. So net, maybe $1,200. So $14,000, $15,000 of rental income coming in, $14,000, $15,000 of appreciation. It's hard to get that kind of yield on any other investment out there. So as long as we have really low interest rates and it's hard to get yield without chasing risk in the financial markets, you're going to have hedge funds want to own residential real estate.
And then also, I mean, you didn't even talk anything about a hedge against inflation, right? You know, a fixed asset, bringing in a fixed amount every single month, that yield that's not going to change, against a hedge of whatever happens in the stock market, whether you believe it's going to go up or down or whatever, it's fixed, right? It takes the volatility out of that investment, so to speak. And so as long as you have hedge funds looking to buy property and in bulk and a lot of cash sitting on the sidelines, you're not really going to see any real changes in the market. Now, understand they're chasing a certain type of property, a certain price point, right? They're not going to come to Southern California most likely and start buying $1 million homes. It doesn't make sense financially. But if you're in a market where the average price is 250 to 350, 400,000, understand that is probably the bulk of where they're looking to purchase. I mean, maybe less expensive if they can, but because of where the median home price has gone in the United States, that's the sweet spot. So understand, if you're in one of these markets and you're wondering at the moment, hey, I don't, it's tough for me to purchase and I'm going to wait. Okay. But if that's the bulk of what they're looking at buying. And chances are, if prices were to pull back at all, guess who your competition is? Your competition is now that hedge fund, that investor, likely with a cash offer. And that's who you're competing against. So, I realize it's one of those subjects that's really hard to tell, all the details, because there's so much money financially sitting on the sidelines in these companies, and most people don't understand it and don't understand like the yield chasing aspect of it and the protection of what they're trying to get their investors. But it's been going on pretty consistently over the last year and a half, and I think you're just going to see more of it as we progress.
Most of us never are faced with the problem that a hedge fund manager is faced with. If you're successful, you get more money, but the only way to remain successful is to put that money to work.
Absolutely.
So you can't put it to work at things too risky, because you lose a bunch of money, then you have big outflows and you lose your reputation and you're out of business. So there's a dance for them. They can't leave money sitting in the bank getting 0%. They have to invest it, but they can't invest it in things that are too risky. That's why housing is really attractive right now. Something that I wanted to talk about, if we look, again, there's not a lot of questions from you guys today, but there's a lot of comments here. And they're either 50-50. We have people saying, yeah, things are definitely staying on the market in my neighborhood or my area, and we're seeing price reductions. And then we also have ones here saying, hey, things sold before processing. We're having lotteries for auctions for lots in new developments. And what I find is the people that I talk to that are convinced that home prices have to drop, they're too high, they have to come down. It's wishful thinking. It's the people that are getting priced out of the market that want or need prices to come down. Because we have every day, we talk to 2 or 3 new buyers a day, probably every day, at least business days, 4 or 5 days a week, 2 or 3 people who can afford, do qualify, and are looking at buying homes all over the price range. On the low end, we have $350,000 buyers. On the high end, we have $2 million property buyers. But people all across that spectrum are buying. And what we talk about here is it always comes back to supply and demand. If you want to tell me that home prices are going to come down, give me an argument that shows that either demand is going to go away or that supply is going to significantly increase. The supply equation, we can just shut that down. There's not a massive supply that's going to come to market. So tell me what decreases demand in a way that's going to cause prices to drop. We certainly could see them level off, to a 2, 3, 4, 5% annual increase, but we're not going to see home prices drop in the near-term future, 1 to 2 years.
No, I mean, yeah, we could go down a rabbit hole. If you want to know how they're going to drop, just read my videos. There's a bunch of armchair quarterbacks that are giving me, dude, there's some real pros on there, bro, and they got all the answers. So that's what you should do. Instead of asking it on here, just go read my video comments.
Well, the thing is, go through those comments and just reply to them. So how long have you been renting? Because 99% of those people don't own a home, and they can tell you exactly why homes are going to drop. If you go back to Reddit has a long history of these people sitting there and saying the same things. And they're talking about 2012, 2013, 2014. Nope, there's going to be another huge leg down. There's shadow inventory. The banks are sitting on millions of homes that they can't sell. And they never came to fruition. They never came to market. It's like the boogeyman. And here we are sitting here with home prices double where they were.
Don't go with the boogeyman. That guy, he lives under my bed, bro. So don't even go there. I lived there since I was a kid. He's still there. So I got a sensor on my light now, guys. So guess what? When I don't move, it goes off. Magic. The boogeyman. He called it right there. The boogeyman said something. guys don't believe it. Anyway, Ashley, your question's been on the screen for about 2 minutes now, so we're going to address it. So got 2 notifications of homes being sold before processing. Do you think this is going to be a common thing? How long or how homes, wow, homes will be taken before, wow, I'm just going to start over.
Don't.
Do you
We
think
might
this
not
is going to be a
we'll
common
be all
thing?
night.
And the answer is it's always been there, right? I mean, people have always sold homes before processing. In this environment, I mean, if you were a seller, in my opinion, you'd almost be crazy to sell your home without putting it on the market, just because of the demand that's out there, the potential to get more than it's, than you might be asking in many cases. But it does happen because sellers don't want people in their homes for whatever reason. Sometimes you have unique homes, a lot of celebrity type homes and that sort of thing sell before ever going on the market. So that sort of thing, not that that's this case, but you always have realtors out there trying to put deals together without it ever going to the market. I do myself. And, I have people reaching out to me trying to get listings and that sort of thing. So I wouldn't say it's going to be any more of a thing than it has been in the past. You're probably just noticing it more now because it's that reticular activator, right? When you notice, you're looking to buy the red car, you notice all the red cars out there. You're looking at houses right now, so you're paying attention to things that you've never paid attention to before, and I think that's probably more what it is than something new that's going to be the norm, so to speak. All right. Did Josh just lose his light?
My sensor just turned my lights off. So apparently it's 20 minutes. We got about 20 minutes, then we have to wave at the light.
All right. So the boogeyman is now in Josh's office. Shonda has a question. Can you talk about what's happening with new construction, specifically the lottery being used to even get a lot? So, this has been around for as long as I can remember with regards to new construction, especially in communities that are in markets that don't have a lot of new construction. For example, here in Huntington Beach, there's not a lot of areas to build property. And ever since, we've gotten new construction, Brightwater was a community that came on, into our market about probably 10 years ago now. And even those homes had a lottery when they were built. And this was before the market took off. Right. And so it's even more of a thing in this environment, just because, that you got people willing to that want new construction and they're willing to wait and so on and so forth. So a lot of them do the lottery system as a way of fair, getting people an opportunity to buy. So I wouldn't say it's any different than it has been. What I see more now that has been different is people actually not even using the lottery system as much as highest and best offer on some of these properties being new construction, just because of the amount of demand and the number of homes these builders can build. Obviously hasn't really increased. So they want to get the most amount of money for that property. So they've gone to the highest and best offer, just like, existing construction. Anything you want to add to that, Josh, on the lottery system there?
No, other than you're dead right. As long as there's a hot market, if you have a really just a standard market where a builder puts up attractive homes and they're selling 1 or 2 a month, you're not going to have to deal with the lottery. But in a strong market like this, and if you remember 6, 8, 9 months ago, probably the most common question that we got here on the show was, I'm tired of losing out in bidding. Should I just go buy a new home? So when you have people saying, I'll go to a new home where I can just make an order for it, well, that market is going to adjust as well. So the builders just said, well, hey, we can take advantage of this and either do the highest and best and get higher prices for our homes, or create this scarcity and making buyers understand that there are more of you buyers than there are lots available to build homes on.
No, absolutely. And then you've got comments, like Howard here saying that construction to perm is going to get big, people going off the grid working remotely. So construction to perm is when you get a construction loan yourself to build a house, and then it becomes, a permanent loan, if you will. So it's basically a construction loan. So they obviously a lot different than getting a loan to actually purchase an existing home. Requires bigger down payments, requires different things. But with that being said, you've got to have land to be able to build those properties. And here in Southern California, that is the biggest problem. It's not like you can just go out and buy a nice lot, and inexpensively and then just go build a home. The problem is you can't find lots that are reasonably priced to start with because they're selling at a premium. Then you've got to go out and get a construction loan, have a large down payment, and then you got to find a contractor that's reasonably priced, that's willing to build your home at a reasonable price per square foot. I mean, there's just so many factors playing into it. These contractors are so busy. And now in other areas of the country, it might be a little bit easier to do, but in big areas that are densely populated, a lot of the markets that have gone crazy, the Boise, Idahos, the Phoenixes, the, Southern California, Texas, it's going to be harder to do that just because of the cost involved in building new construction versus just buying something that's existing construction. And you could even talk to doing a remodel with a contractor now, the premiums that you're paying just on a remodel in the flip that you're doing.
No, that's what I was going to say. We get a lot of inquiries from people asking about construction to perm financing. Hey, want to do this? Prices are just too nuts in my area. I can get a lot for this, and I'm pretty sure I can build for this amount. And it doesn't take into account that these contractors are really, really busy. And my contractor that I work with is a guy that we'd flipped 20, 30 houses with 10 years ago, and he's still in the business. And from his perspective, remember, a general contractor, they don't do all of the work. They have subcontractors for specialties throughout that process. And he is blown away throughout this process of what painters are getting right now, because there's more jobs than there are painters. What a drywall person wants. We had a little flood damage on that property, and it required some additional drywall work. It should have been like another $1,200. It ended up being like $3,000 because every drywaller is super busy. So they give you the make me an offer I can't refuse number. Like, hey, tell me you'll pay me so much that I can't not come and do your job. So just a long way of saying, for a first-time buyer, you probably need to have a construction background, having worked in construction and project management, to even think about it. The reason being is you have to negotiate with the contractors. You have to make a million choices. You have to get a more complex loan. You're buying a lot, and then you're managing this process that is 6 to 18 months, and then you're having to live somewhere while you're doing that. Like, the complexity of that versus Jeb writing an offer for you and you get it accepted, and 30 days later you hire the moving vans and move up. It's exponentially more difficult. And I don't know, I would much rather have a move up buyer with $300,000-$400,000 cushion that they're leaving their house with than someone just saying, hey, I've got $15,000 and I want to buy this lot and build a home. There's not a lot of margin for error there, and there are a lot of things that can go wrong. So in theory, it sounds like a great idea. It's a scary thought for most people to step into that.
No, absolutely. So with that, I mean, we got Rose asking, can you explain why escrow takes so long? 30 days plus or minus. What are buyers, lenders actually doing during this time? So what happens is when you buy a house, there's a lot of paperwork that needs to transfer between, if you're in an escrow state, if you're in an attorney state, whatever, that has to cross paths, has to be, I's dotted, T's crossed, title reports pulled on properties, that sort of thing. But with that being said, there is quite a bit of downtime in the process of buying a home, right? I mean, Josh, we're putting in offers right now for a couple of different buyers, and most of our offers we're putting in around 21 days. So you don't need 30 days, but 21 days, and maybe even less in some cases to get them done. But what's happening is, you're getting home inspections done, you're getting appraisals completed, which appraisals in this market in some cases are taking weeks to get done. Josh can tell you here in a minute that, an appraisal was 2 weeks is what they were quoting. In addition, you got HOAs. If there's an HOA associated with the property, these homeowners associations, you're dealing with third parties, so to speak, in a lot of ways, right? The escrow company, the attorney, is kind of the middleman, if you will. They don't work for the buyer or the seller, or at least escrow companies don't. They're just facilitating the paperwork on everyone's behalf. And you've got to, you're waiting sometimes for people to do things so that you get them. And HOA documents is one of those things. Sometimes you're waiting for the escrow company to get you those documents, and you're waiting for things to be, back from the seller, so on and so forth. So if everybody's on the ball, everything is done in a super timely manner, you can get things done a lot quicker than 30 days. But 30 days allows people to not have to rush in many ways and still meet the deadline, right? And a lot of lenders aren't lending their own money, right? Like Josh is a broker, so he's brokering that to a larger investment company, if you will, investor, and they have to underwrite the file. They have to come back, and ask for certain things. And then when you send in those documents, they have to check them off to make sure that they're, those are the items that they requested. So there's just a lot of moving parts, and doing it any sooner than say 30 days. I mean, honestly, 30 days goes by in no time. So it's, it gives the buyers an opportunity to do their due diligence and not be rushed along the process.
So from the lending side, there's a couple things I want to add to that. You cannot close a purchase transaction in less than 8 days. The government passed some guidelines.
I wasn't aware of that.
So we went from, back in the day, Jeb, when it was a good faith estimate, which was whatever numbers the loan officer scribbled down on a piece of paper and said, hey, hope that's what it looks like at the end. And then you would show up and you would see your estimated settlement statement from the escrow officer and go, this looks nothing the same. So the government wisely said, hey, we got to set some parameters of how accurate your upfront estimate needs to be. So you get a loan estimate within 24 hours, within 72 hours of you going into contract. Once we have everything, we have to get those disclosures out to you within 72 hours. So for us, what does that mean? Because we're held to tolerances on those numbers, we have to reach out to escrow, who's going to tell us what their fee is, what title fees are, what recording fees are for your area. If you're in a more complicated area, like an attorney state, what's the attorney going to charge? All that stuff. Because we as a lender are held responsible for the tolerances on those and getting you accurate figures. So it takes us a day, maybe 2 days at the most, to gather all the third-party fees, get your disclosures out to you. We can't really go into underwriting until you sign that loan estimate. So we have a signed loan estimate, goes into underwriting. Most of our lenders right now are 1 to 2 days in underwriting. So you say 1 to 2 days to get the disclosures, 1 to 2 days to get into underwriting, and now we know what they're asking for. So as Jeb said, during that time frame, we've ordered an appraisal, you've done your home inspection. So really, where I started with that is we can't close for 8 days. From the time you sign your loan estimate, you can't sign your loan documents until the 8th day. So that's a perfect world of everything happening there. I can say that we closed 3 loans this month, one 14 days, one 15 days, and one 17 days. And for all practical purposes, for everything to get done, think of all of the people that are being coordinated. You have buyers, you have sellers, you have escrow, you have title that needs to do work, you have the lender that needs to do the work, you have the appraiser that needs to do work. As Jeb said, you have the HOA. Everyone coordinating there, really 2 weeks is about as quickly as it can happen. And as a buyer, you're probably going, well, this is weird. I'm not really doing anything. I'm getting communications from everyone telling me things that happened, and I have some documents I want to look at and review, but you're not doing much. But everyone's doing work on the back end, and all of those things, it's almost like you have to get in line. So for underwriting, the underwriter has a queue of files they need to underwrite that day. So just when we submit it to underwriting, it doesn't mean the underwriter is waiting for that file. If you look at it like an assembly line, yours has to get to the front of the assembly line. They work on it. So a lot of it is just multiple parties doing multiple things and everyone having to wait in line through the process. But as Jeb said, most of the offers we're writing now are 21 days. We're getting deals through 15, 16, 17 days for well-qualified borrowers, but 30 days is more common when things get backed up, when lenders are a week in underwriting. A year ago this time, last August, appraisers were absolutely buried. The appraisals are still taking longer than almost anything else in the process, but a year ago it'd be 3 weeks to get an appraisal, and in some parts of the country it still is. So those are the things. It's like we say you're only as strong as your weakest link. Whoever is the slowest in that process, the process has to be long enough to accommodate them.
No, absolutely. Got some more questions here with regards to let's see here. The process. So Let's see. Angel Eyes says currently in the process. FHA have a conditional approval. Still need an appraisal. I'm glad I found the home when I did because oh, okay, never mind. I thought that was a question. I read one a moment ago that I wanted to go off of, and I can't find it now. I can't remember what it was.
But regardless, Angel Eyes, congratulations on getting something under
absolutely.
contract. That's the hard part. The 30-day process of just waiting and connecting the dots is generally pretty easy. The hard and stressful part is getting out and finding a property. So congrats on that.
Yeah. So Guacali. I currently have a 1-year rent agreement that expires in December. Could I still apply for a home loan now and eventually just pay the fees for not staying in the place I rent until the contract ends? Absolutely. I have many clients over the years that are in a rental. They have a rental agreement until a certain period of time, and they go out and start looking at property. Usually there's a fee to break it. In this market, because of where rentals are going, what I mean is there's a lack of rentals as well, and a lot of people are getting top dollar for rentals. Chances are you could probably talk to the property manager and get them to lease that property while you continue to pay it. Therefore, you wouldn't be stuck with the full amount. But it's a conversation to be had. I wouldn't have that conversation unless you're seriously looking. But it doesn't hurt you to get pre-approved now to know exactly where you stand. December is not that far off, and based on where the market's going, it could take you a couple months to actually find the right property. So you might not end up having to pay very much at all with regards to leaving by the time you go into escrow and end up closing. So, but to answer the question, absolutely can do it.
We have this exact situation for a viewer here that came through the channel, and we qualified him and his wife back, I want to say like March, April, and he said, hey, I just signed my lease. It had to have been April or May because he just signed the lease extension. I'm here through next April, but we have some variable income, some things that I'm not sure about. I'd love to get pre-approved now just so I know that in 12 months I'm going to be good. Well, after about 2 or 3 months, prices continue going up, and he starts reaching out. Hey, can you give me a pre-approval letter for this? Hey, can you look at this? And the decision was made. Home prices were going up more rapidly than what the small cost to break his lease, as Jeb was going through. And he's in process right now and is one of those files that we're going to close in 17 days this month because they found a home and just made the decision. And for them, so one thing for you to know, if you're in a really slow rental market and you break a lease and they can't find a new tenant for 6 months, yes, you are on the hook for the cost of that lease. In a really hot market like this, when they put a sign out and in 2 weeks they have it leased, your downside is fairly minimal. You always want to go through it with your landlord, tell them what you're thinking, and prepare for the worst, but know what the likelihood is there. But it can absolutely make sense when the market's still going up pretty quickly.
Absolutely. Collector Finance, Gen Xer Gal. Wow. It's a lot to say. It's not really cooling. Talking about the housing markets, the normal seasonal slowing. Please just be straight with buyers. Prices will remain extremely high. We all know it. So, it's one of those things that, honestly, like I believe. Yeah, I do believe of a lot of what is said there, but it's hard to say that I don't know that prices are going to stay extremely high, but I don't think they're going anywhere, right? I mean, and that's the tough part, right? I don't want to be the guy out there preaching that house prices are going to continue to rise and rise and rise over the next 18 months, 2 years, whatever. And that's why I say, prices going sideways to maybe up. But the reality is, unless something changes with supply and demand, you're nailing that comment head on, right? Prices will continue to be extremely high. And it's not something that I really want to see in the market, right? I'd like to see some slowdown. I really would, because if it slows down, it gives us more sustainability. It gives us the ability to kind of keep things moving along without crazy appreciation. But I just don't see a lot happening on that front that's going to change prices anytime soon.
So Jeb,
yep.
Look at this, and I'm reading something, and we're reading 1 or 2 or 3 sentences from this lady, and reading into it. Say another comment here, and from talking to people, we talk to people all day, every day. You talk to 3, 4, 5 people, both buyers and people from the channel. Same here on this end. So we have Kay Lore says, can't wait for prices to go down in Orlando. So when you talk to people and you hear what their thoughts and their perception are, you almost get to see what their hopes and their fears are. When someone says, hey, just be honest with us, prices are going to stay extremely high forever, it's almost someone that feels like they've got priced out of the market. I'm not saying that's her perspective, but a lot of times it's someone that's got a little bit priced out of the market or is not getting what they wanted for a very expensive price. Like for us, here in Orange County, $750 gets you an entry-level home. Most people are thinking $750,000, that's $750,000. I should be getting a pretty darn nice house. So, and then we have other people here, I can't wait for prices to go down. Well, anyone who doesn't own a home would love for prices to go down so they could have a more effective entry point. But it's really interesting, the different perspectives that people have, and from reading into their comments and the questions that they asked, you can almost tell the perspective of where they're coming from. We're just trying to give you real numbers of where the market's at and what's likely to happen going forward. The supply-demand equation is not going to change anytime soon, and until that does, we're not going to see a significant downturn in prices that would enable folks who are not in the market and would like a better entry point to have something more affordable.
Absolutely. Absolutely. Jabiz, first-time home buyer from LA. If I don't find a home in a location I like in my budget, do you still recommend that I buy a property in my budget now and change it in a few years? This is a tough question. I think you should never settle on a property. I do believe that. I don't care what the market's doing. Don't settle to the point where you're going to regret that decision. Now you gotta have some non-negotiables, right? I mean, you need to have a list of things that are important to you and things that are nice to have. For me, location is everything. Because I'm not going to buy a house that backs to a freeway. I'm not going to buy a house that backs to a super busy street. There's certain things that I won't do as a buyer, regardless financially of where I need to be, because I don't want to deal with that. Plus, I know when I go to sell it at some point in the future, if I decide to do that in a market where there is more inventory and less demand, that property is going to sit on the market, and or I'm not going to get top dollar. That's the reality. But what you're seeing in this environment, Josh and I were talking about it earlier, is that if your house is in an awful location, now's the time to sell it, because you don't have a lot of competition. People are willing to pay top dollar for those properties, even though there are issues with it. So I would tell you not to settle on location, but you have to be okay with that, right? It's what's important to you. I have a client that backs to one of the busiest freeways in Southern California. Literally, I mean, it sounds like you're sitting on the freeway when you're in the backyard. He was okay with it. He's still okay. He's still there. So, to each his own, but you have to understand what that means at some point in the future, if and when you do decide to sell it. It's going to have an effect on the value, unless you're in an environment like we are in now, where things are moving, even though there are potential issues with it. But make that list, non-negotiables, and stick to it. And that would be my way of guiding you if I could.
And
Josh,
think about it. The question here is sort of a combination of a couple questions or a couple things that we've talked about here repeatedly on the show. You don't want to say, someone asked last week, I want to buy a place and then move in a couple of years, but I want to get into a condo. Like, okay, it's dangerous. It can work out really well. You can make a nice chunk of money, but the transaction costs of getting out of a home are fairly high, somewhere between 5% and 8%. So if you buy a $400,000 house, 6% to get out, it's $24,000. So you need 6% appreciation just to get you back to where you're at. Now, the flip side of it is, we've talked about, you can't save money as fast as the market can go up because it's leveraged. So you're saving $1,000 a month, and a $400,000 house that goes up 5% the next year is going to go up, $1,800 a month. So it's hard to keep pace with that. So you absolutely want to balance it. In a perfect world, you would want to know you're going to be in a home at least 5 years. If things work out, you buy something that's suboptimal right now, but you can build some equity and then move in 3 or 4 years, that's great. But I wouldn't buy anything that you're not prepared to live in for at least 5 years, just because of the transaction costs and the potential for a change in the market, however unlikely that may be at this time.
No, I would agree 100%. I mean, I would almost rather, and this is going to, some people are going to say, well, Jeb, you preach this all the time. How can you go against it? I would almost rather up my budget a little bit and try to find a home in a better location than keep my budget the same and sacrifice the location. So, and budget is extremely important, but buying a home in a location, that is desirable, somewhere you got to come home to every single day. It matters. And so if it's one or the other, I would just change my budget a little bit if possible, if you can find something in your range. But
think about
for you
this,
to
Jeb.
decide.
Yeah, I would say at least half. I'd have to go back and run the numbers, but about half of our buyers are first-time buyers. And what I can tell you about first-time buyers is 80% of them are uncomfortable with what their mortgage payment's going to be. And some of them are pinned at the maximum debt-to-income ratio. Some of them are really conservative and they're well below that. But 80% of them are concerned this payment is too much. My first-time buyers probably get tired of hearing me tell this story. Back in 1997, bought my first condo. Payment was $1,138 a month. And I went from living at home rent-free to having to pay $1,138 a month. And that puckered my ass. I'm sitting there going, how in the world am I going to pay $1,138 a month? And after about 3-4 months, you just write an $1,138 check every month. So the numbers change. Most people today are talking a $2,500, $3,500, $4,500 check every month, but you get used to it. Lenders are not in the business of lending money to people who won't pay them back. So if they've determined that you qualify for the loan, you have the ability to pay it back. We always talk about, I can't tell you what you can afford. I can tell you what you can qualify for. That's true. But it's also true that lenders are not going to set guidelines that are putting people at risk of losing homes, because they're not in the business of taking back homes. They're in the business of lending money and making money on the interest that they get back. So for what it's worth, you're going to be uncomfortable with that payment, but as Jeb said, I would rather be a little more uncomfortable and have some insurance that I'm in a happy, safe, comfortable place that I'm willing to be longer.
No, absolutely. I'm going to throw you a softball here and ask you, do verified funds such as money from a paycheck need to be seasoned to use a down payment, to be used as a down payment?
Anything that you can document the source of, like a paycheck, that's valid source of funds. So as soon as it goes into your account, as long as we can show the pay stub showing where it came from, you're absolutely fine. And something that people should be aware of, I'm going through this with a buyer on a property right now. On a conventional loan, as long as the deposits are less than 50% of your monthly income. So in this situation, the buyers, they make $12,700 combined a month, and they had a $5,500 deposit, and they were worried that we were going to have to explain where the hell it came from. It's less than 50% of their monthly income on a conventional loan, they're absolutely fine. On an FHA loan, it's 1% of the purchase price. If you're buying a $500,000 home, as long as it's $5,000 or less, we don't have to explain it. Now, underwriters can get picky on this one and sort of freak out and say, well, it's $5,000. I still need to know where it is. But the guidelines are on our side. We can fight the underwriter even if they ask for it.
So let me ask you something on that, because that's news to me. I didn't realize the 1% and the 50% of your monthly income, your combined monthly income. What if I had $50,000 in cash, and in that case I make $12,700 a month or whatever that number is, and I have 50% or less? Can I make 10 $5,000 cash deposits and it not raise a flag or something like that? Is obviously because I'm pushing the boundaries there.
In theory, you're pushing the boundaries. You're correct. And I had that same situation where we had someone do two $4,500 deposits and we got away with it, but we were straining the comfort limits of the underwriter on that one. If you had 8 or 10 of those deposits, they're going to go, no. And the reason why, our underwriters just hard asses. They want to know things. They want to ask where in the hell your money came from. No, their concern is that you borrowed that money and there's a debt somewhere that's undisclosed that we haven't accounted for in the debt to income ratio. So they just want to know that it came from a source that's really yours. If someone handed it to you and gave it to you, they don't care as long as it meets the gift guidelines and we can document it. And it sort of falls back to, if you're getting gift funds from a family member, why do we have to show the donor's ability to gift? Because they want to make sure that you didn't go out and borrow $50,000 from someone, hand it to your brother and say, hey, give this back to me, and it's now sourced. So again, it's not to be a pain in your ass. It's to make sure that the loan is a solid loan and you're going to be able to repay.
All right, we got some good questions here, but we do have our boy Joey Crackback with a $5 super chat. So thanks, Joey. Josh, you're going to have a field day with Joey here because I know you spent a lot of time talking to him about different things. So he is now exploring land and building a home. What are the hangups that come with construction loans as opposed to home style loans? Maybe explain what a home style loan is too before in the process.
Yeah, home style is a renovation loan. It's a conventional version of the 203K. So the difference would be they're very similar. One, you're financing the purchase and rehabilitation of a property. The other, you're financing the purchase of land and putting a property on it. So a little simpler when you're starting with at least a structure on the property, but not necessarily. I've seen 203Ks where they pretty much rip the house apart and put it back together 90% brand new. So Joey, I don't know if you were watching when we talked about this just a little bit back, is we get a lot of the stuff of people saying, hey, I got priced out of the market, but I can find a lot for $100,000. I think I can build a house for $200,000 and I can afford that. So let's do it. The pitfalls of that is if you're a first-time buyer that has 3% down and maybe a couple $1,000s for closing costs, you have no margin for error in that process. Any budget overruns, anything that changes, a contractor screwing up, a contractor making off with some of your money and not doing the work. So those are the things that you need to be aware of. So go into it with a big contingency reserve. And I'm not saying double what you think you need to have, but if you go through it and say, here's my construction to perm loan that's going to buy the land, pay for my construction, and they're telling me I need $100,000, make sure you have $140,000 or $150,000 because you'll get in, you'll start building your home. Think about the people who got their construction to perm loan early 2020. They had no idea that by the time they got their permits and started building in late 2020, that lumber prices were going through the roof. It has to be accounted for. No one's going to eat that cost for you. So things can happen, whether they're nefarious or just market movements. Things can happen in terms of pricing of everything throughout the process. So it's not as simple because you don't have the fixed cost of saying, I'm paying you this for this already constructed home that we're going to close on in 30 days. You have a longer time horizon, you have way more moving parts, and you have different relationships that you need to manage. It's not just realtors and mortgage people, it's realtor, mortgage, contractors, subcontractors, landscapers, all sorts of people that you're dealing with.
No, I agreed. And Joey kind of went a little bit deeper into it earlier as well when we talked about the construction to perm and that sort of thing. So if you want to go back and check that out, you can. He also says when he missed us, we swapped facial hair. So he's been gone long enough for me to grow a beard, maybe shave, and then regrow it. And you've been baby's bottom there this time. So
yeah, this is as close to baby's bottom as we get at 48.
We got a good question here. Normally, I don't like answering questions of people that can repeat them behind, but it's a good question. I want to talk about it. So Brian asked a question. I want to buy a house, but it has a solar power purchase agreement. Is that bad to buy? So this is one of those things that's to each his own kind of deal. I'm not a solar guy. I like the idea of solar. I understand what it does. But understand that most homes, at least here locally, don't need solar. The cost to put it on and how long it takes to pay that off on versus what you're saving will take 30 years in many cases. I mean, it's going to take way longer to pay that off than it's ever worth. Now, in some markets, when you're running a pool, you're running, AC, you've got all of these different things and your utility bill's $500 a month, then yeah, maybe it makes sense to have solar. But my utility bill, my power bill a month is like $100, and so it would makes no sense for me to get solar or deal with that. So you just got to understand, like, if you're getting a mortgage and it costs you money, or if you're doing a refinance or whatever, and it costs you X amount to do it, and you're saving X amount, divide what you're saving into that amount, find out how long it's going to take to pay it off, right? For you to get back to even. I would say the same thing goes for solar. If you're buying a house that has solar, okay, what's a normal utility bill prior to solar? Get documentation, find out what it is. Then how much is it going to cost to pay off that solar? divide it in there. How long is it going to take you to pay that off? And also understand when solar's paid off, that doesn't mean there's no more expenses associated with it. You still got a cost to maintain it. If there's an issue and the warranty's out, it's your responsibility. So there are other things. I mean, nobody's factoring in the cost to do some of these things over a period of time. So, I wouldn't say it's an awful idea every time, but just know that if you are buying something with solar, it may or may not make sense when the homeowner put it on there. So you just need to do your due diligence and make sure that it makes sense to you. But from a standpoint of buying it with solar, if there's a payment associated with it, obviously the lender's got to factor that into your debt to income ratio as well. If there's some sort of additional payment that's associated with it, and you've got to be able to qualify with that, and so on and so forth. But anything you want to add on the solar topic there, Josh?
No, I'll just throw in numbers never lie. Run the numbers. Know what the utility bills are without the solar. Know what the solar costs. If you're super environmentalist and you say, hey, I will pay more to save the universe, totally justifiable reason for it, but know what the numbers are and know what you're paying. Other than folks, for us, if you're out here in Riverside, San Bernardino, and you have a pool, so you're in a hotter area that 4 or 5 months of the year, you're running AC large portions of the day and you're heating a pool, the numbers can justify it. For us, Jeb and I live here in Huntington Beach. Both of us have air conditioning and it gets used, 40 days a year, maybe, and that raises my my electric bill to maybe $180, and in the other months it's $65, $70. I don't have 3 rugrats running around playing PlayStation all day, so we don't use nearly as much electricity as
it's not that, bro.
Jeb's
It's
household.
leaving the lights on in every room in the house. That's the problem. And leaving the door open when the air conditioning's on. I sound like my parents.
Yeah, that's what I'm going to say. I was wanting to know if they could tell which one of us is the grumpy old man and which is the friendly uncle.
Anyway, and then Brian went on to ask a question about buying a home with a sewer manhole in the corner of the backyard. You've got to, that's to each his own type thing too, right? I mean, there's some sort of easement associated with that, right? So they've got to be able to come on and use that if necessary. If that backs up, what's the repercussions? I don't really know. I mean, I haven't come across a home in my career that has a sewer manhole cover or hole in the ground, so I'm not familiar with it. If it's in your area, if that's a normal thing, then probably not really a big deal. But if it's one out of however many homes you've seen and that's the only one your realtor's ever seen, then maybe something that you should reconsider. But just understand what comes along with it if you were to buy something like that.
It's not the same as a manhole cover, Jeb, but in my neighborhood, about every 12th or 15th house, they have an underground power transformer in their yard. And we've seen some very creative landscaping to disguise them. Whenever I see one, I say, there's no way I would not buy that house. That would annoy me because they're big. And your manhole's, what, 3 feet? This thing's about 5, 6 feet. And about every 7 or 8 years, that transformer is going to blow and you're going to have 20 guys in your yard for half of a day replacing it. So to me, I say I would never do it. And I look, whenever one of those comes on the market, doesn't seem to be a discount that happens for it. It's almost like we talked about, a month ago, someone asked, what about the stigmatized home where there was a murder-suicide? Some people that doesn't bother, and in a good market, they're going to pay just as much. So it really comes down to how strong is the market and how much does it bug people, because obviously in my neighborhood, there's some people that are not in any way bothered by an underground transformer in their yard.
No, again, it goes back to what somebody's comfortable with and what they're not. Golden Gate here asked me a question a couple weeks ago on the CFPB guidelines that going into effect on 8/31 impacting foreclosures. I looked it up. I Googled the headline and I can't find anything that that came across to me that I thought was anything that would impact foreclosures at all coming from the CFPB. So if you have an article, send it to me. I'll read it, but I couldn't find anything that I thought was any more than what we've already discussed on the channel. Just FYI, I didn't forget about you. I actually had a note and did try to research it a little bit. Let's see. So also, Red BlackRock is behind Invitation Homes, and they are buying mass homes due to money printing and then finding them a place instead of treasuries for money. Do you see this getting worse with higher prices? So we talked a little bit about this earlier about hedge funds buying homes. Again, I think they're part of the reason that homes in certain markets are the prices are being driven up as much as they are. I don't see much changing in those markets as long as inventory continues to go on. At some point, maybe homes become too much price wise for what they're willing to purchase them at, based on the yield that they're looking for and that sort of thing. But at the moment, we haven't hit that, and I believe that there's a lot of money still sitting on the sidelines, looking for opportunities to purchase property. So I think it's going to be around for some time. I don't see much changing on that front.
Jeb, look at the history of it. Before like 2010, there weren't any large investment groups buying these, and they started looking around going, this is crazy. You can buy a property that will rent for $1,500 a month for $125,000, and just the yields were astronomical relative to anything else you can get. And the thought was that this will be a headwind for the market in the future, because home values are going to go up, and then these hedge funds are going to start selling all their properties. They're going to say, hey, well, home doubled in value coming off the lows of the last bust, and we've got our nice yield, and now we want to bring the cash register and go reinvest this money elsewhere. And we haven't seen it. Home values have gone up more than what almost anyone would have projected. We all expected that we were going to see a nice recovery over the last 12, 15 years from what was incredibly low home prices, as that bust really shook things out more than the fundamentals would have implied. But to sit here and think that they would have made that much money on their investment and are still buying into the market, again, it tells us we have people here in the comments going, oh, this is a bubble, home prices are going down, can't wait for a better entry point next year. And yet people with billions of dollars are buying into these prices as much as they can. And as Jeb said, they're not buying in Los Angeles, California. They're not buying on Miami Beach. They're buying in areas, bread and butter, $250,000, $300,000 homes in solid rental areas, but they're still buying hand over fist and putting new funds together to do it. So the fundamentals of supply and demand absolutely support higher prices. And as long as they do, you can get the yield of the rent and have some capital appreciation on the investment. We're going to have big investment groups buying homes.
No, but you mentioned that, they're not buying properties in, say, Orange County or Los Angeles County in your example, but who is buying those properties? I mean, in some cases is the Zillows, the Open Doors, these other iBuyers, if you will, and they're paying crazy prices for these properties. I mean, I had an agent that I know. I just sold a property in Seal Beach, and we had identical properties listed. Mine was a little bit different because mine was a corner and an in unit, but his was interior, a little bit nicer on the inside. Mine needed work, but nevertheless, him and I talked about what we thought those properties were worth prior to putting them on the market. And I said mine was worth $550, I believe, and he kind of agreed, and that's where we were pricing them. Well, Zillow made an offer on one of his properties at $585 prior to it ever going on the market, because the buyer went to Zillow and said that they would give him $535 or $585. Well, at $550, we were already pushing the prices on those properties, right? And so Zillow was coming in willing to pay $35,000 more for that property than he was, than we thought it was worth. That's just one example. I have another example of, an agent that I know that listed a property or had a conversation with a seller and what she thought it was worth. And Zillow came in and was willing to offer $100,000 more for that property than they were willing to list it at. And they ended up closing the property with Zillow. So I do know there's companies out there, the Zillows and some of these Open Doors, buying property for more than us as realtors think we can get for them. And a lot of times, we're wrong in this environment. I mean, I'll say it, we're wrong on the prices because we don't know what a buyer is willing to do, in this environment, right? When they've been missed out on multiple opportunities or what's driving them to a neighborhood or a property or what have you. So sometimes buyers are willing to do crazy things, but when you start talking, 10% more than we think it's worth, I mean, do they know something I don't know? Maybe. But nevertheless, it just shows you that, the demand is still there and it's coming from all angles. It's not just, investors, with cash. You're talking big companies now getting involved in this whole thing.
And the thing that's weird about the iBuyers is they're not buying to hold, we're talking about the reason why hedge funds are not buying in these areas is the yields. Right. The rents, although our rents are astronomically high, as a percentage of the home value, they're not as high as other more bread and butter areas. So you're concentrating your risk for a lower return. But these iBuyers are selling these with the thought of making a profit. So you've talked about it before. They have their big long contract and monstrous fees, but on that property that went $100,000 higher than what a reasonable agent thought it would sell for, they didn't have $100,000 of fees in there. So even net of their fees, they're above what a reasonable agent thinks that home is worth. So we actually had a comment here. Another agent here, also in Huntington Beach, found 2 new listings in Costa Mesa owned by Zillow, not liking this trend. So it's just interesting. We're looking and saying they're overpaying for these properties and they're putting them back on the market. It'll be interesting to see how that shakes out, because it's a very different phenomenon than the hedge funds buying to hold and profit over the long term.
Well, we know based on their earnings that they're not making money. They're actually losing money as a company, right? But they're gaining market share, and in some that's what they're trying to do in many ways. So, like you said, it'll be interesting to see how it all plays out. But I mean, at the moment, it doesn't look like they're just, they're not getting stuck with a bunch of property. Maybe they're not making the return that they thought they would make after all things said and done. But I don't think at the end of the day they're losing a ton either. But again, it will play out as time goes on. Just hard to say at this point.
Hey, we had another comment over here that I had forgot. You just answered a question and said that you don't love solar because the numbers don't always pan out. But something I had forgot, here in California, our overlords have decided that all new construction must have solar.
Right.
And again, in parts of the state, it makes all the sense in the world. And if you're in Arizona, it probably makes all the sense in the world. It's just sort of crazy that the government is dictating whether you have to have solar, whether it makes sense or not for your area. I mean, hopefully we flash forward 20 years and the prices on panels have come down and it makes sense for everyone to have them. But it doesn't now, and the state of California is mandating it.
I have a little bit different opinion on new construction because it's on there, it's mandated. You don't have a choice in that case, right? So it's there, and you're going to reap the benefits of buying that property, initially with regards to your utility bills, and you don't really have a cost basis otherwise to justify it. But when you go out and, I have a perfect example. I have a client that we sold his property. It's been a year and a half now, maybe 2 years, over 2 years. I'm awful with time when it comes to this sort of thing. And it was in Buena Park. And at the time, he had purchased solar panels on his property. I think it cost about $40,000 to put solar panels on it. And this was a $600-ish $1,000 property at the time. And shortly after getting solar panels on it, him and his wife decided they were going to get a divorce. So now he's getting a divorce on this property. And mind you, he purchased it VA loan, 100% financing. He'd been in it a year, 2 years, get solar panels on it. So now he's in a position where he owes more on the property than it's worth because of how much the solar panels cost on that property. He's in a position where he has to probably short sell that property. And it took a miracle to get this thing done. And I ended up basically waiving my entire commission almost to get this thing done because they were in a hard spot. It was gonna end up being a short sale. It was gonna be a big issue if we didn't go this direction. But it took quite some time to get through that process, find a buyer that was willing to take on those solar panels to begin with. And what we were able to do is get the appraiser to be able to appraise the property high enough with the solar panels to be able to pay them off through the loan, so that they ended up getting paid off. But I can tell you that without a professional and somebody that was creative on that, this thing would have never gotten done. And at the end of the day, it was $40,000. And I think his utility bill was like $200 a month. So, you do the math. It was going to take forever to pay these things off, but for some reason, it seemed like a good idea to him at the time. So, again, the numbers never lie. So just make sure you're going through it and
that's my line, bro. That's my line.
Well, I just stole it. We had some good questions here regarding loans. I wanted to get one to you here. And to set you up once again.
Find that. I'm going to tap on a couple of comments here
All
that
right,
were actually good. So if it makes anyone feel better, I've seen Zillow buy a lot of undesirable houses, cut prices every 2 weeks, and have now cut them below what they paid for it. Patrick saying here that Zillow is selling many homes in the area for a loss now, and then says to Rose, I can confirm it, price cut every Friday. It's really bizarre. We saw Amazon do it for 15 years. They never made money. They lost money. They sold stuff. They dropped it on our doorsteps at a loss before they got economies of scale and enough market share that they're profitable now. It could be the only thing that Zillow imagines they're doing with this, because it doesn't make sense to buy homes and resell them at a loss.
But you also have to understand, when Zillow does this and these companies do it, we don't really talk commissions, because it's one of those forbidden things. But understand, when they're buying a home from a seller directly, they're charging a commission. Okay. And in some cases, it might be upwards of 5 or 6% they're charging. Plus, they own the escrow company, they own the title company. They've got, they're getting money from many different directions. So just because they paid, say, $1 million for a property, and they end up selling it for, say, $970, it looks like a $30,000 loss to you. But did they really lose money when they factored in the commission that they made on the purchase of that property? Because they're able to take that off of the gross amount, if you will, right? I mean, their net is actually less than you think it is because of some of the ways they built in some of these fees and some of the fees they charge. So, and very well, you could be 100% right on your assessment that they're losing and dropping, but also understand it's not just the price, right? There are other things built in order to help them insulate their selling price, and that's another thing. If a seller and you're considering selling, understand that again, it's not just what they're offering. There are fees involved in doing that. So. But the question I was going to ask, Josh, somebody, Hazim Mohammed said, can I get a cash gift from a non-family member to buy a house? Is there an amount limit?
There's no amount limit to any gift. I wish that we had a second here where I could pull up and show you guys. Conventional loans, Fannie Mae and Freddie Mac, look at it a little differently than FHA does, and we don't include VA in this because you don't have to have a down payment, so you don't have to get gift funds, or wouldn't need to get gift funds for a VA loan. FHA has a very short list of people that qualify as an interested party who can give you a gift. So one of those that makes it broader is someone who has a long-standing family type interest in you. So we had a situation here recently where one of our realtors, her daughter's fiance was buying a house. So no family relationship there. She was able to give the gift for them to purchase that home, for the fiance to purchase that home for that reason. Conventional is a little bit more open on what the relationship is. And what I will say in this is an area where, I mean, fraud's fraud, but they don't research these relationships. So a lot of times people will just lie that there is a family relationship there. Family relationships are the easiest. They're not the only ones. There just has to be a good and valid reason as to why this person is giving you a gift.
Right, but with a gift letter, it doesn't state the relationship on it, does it?
Absolutely states the relationship.
Okay.
Yep.
My bad. All right.
Yep.
Well, then there we go. Yeah. So little white lie never hurt anyone, right? Anyway, drama attic. For first-time home buyer, what other fees should we expect at closing other than the down payment and the closing costs? An example: $450,000 home, 20% down. I'd say prepare another $15,000 for closing. Want to make sure I'm ready.
So we went through this about a month ago, and we're lucky here in California. We are an escrow state, fairly low closing cost state. So in this example, I would say on the low end, you're probably for closing costs and your prepaids, your prepaid taxes, your first year's homeowner's insurance, some prepaid interest, all that fun stuff totaled up. You're probably looking on the low end 2%, and on the absolute high end 4%. When we said that a few weeks ago, of course, one of our New Yorker viewers piped up and said, "Ha, that's crazy. We're an attorney state. You're looking 6 to 8% easy." So I will go hard for all escrow states that 2 to 4% is a very safe number for you, and there's ways to get that lower. But if you're in an attorney state or a high closing cost state, it can approach that 6 to 8% level, as we have been so insightfully informed by viewers from the higher cost states.
And then also keep in mind some things that you might have to pay out of pocket in that process too that aren't really factored in there are your home inspection, right? If you get any inspections on the property, that's something you're going to have to pay. Also appraisal. Now appraisal will show up on your closing statement at the end, even though you've paid it, but it will in most cases need to be paid out of pocket up front. So you're going to have, $500 or so for an appraisal, depending on your state where you're located, if there's a rush fee involved, all this good stuff, and a couple $100 easily for a home inspection as well, depending on the size of the house. So just know that that's in addition to what we just talked about there.
So, and I didn't close the loop on that example. 2% would be 9,000, 4% would be 18,000. So 15% is a very safe number for closing in prepaids in an escrow state. If you're one of those really high cost areas, could be $20,000, $25,000 from what we've been told. Now, Jeb, I am really enjoying the comments above and beyond the questions that we're getting today.
Oh boy.
So we have Bandit One says, our best realtor here in North Idaho is your Governor Newsom. I hope Elder gets in and Newsom gets recalled. People up here want a California exodus from Idaho. So I can vouch for that. Most of you don't know, I went to Eastern Washington University, which is right across the border from North Idaho. It's a beautiful part of the country. I have family there. My mom, my grandma, my aunt, my cousin all live there, and thought that we might join them someday. But now no one likes California.
You got priced out.
We got priced out, and no one likes Californians. So there's anti-Californian violence, and on top of that, we got priced out.
No, and I will even go and tell you that I have an Idaho regret. I used to own an investment property in Idaho back during the last housing debacle. It was in Meridian County. It was actually in Boise. And, let's just tell you that property's probably worth 5 times what I sold it for.
I was going to say 3 times. You think it's worth 5 times what you sold it for?
I haven't looked it up. And in fact, I don't want to look it up. It's like a punch in the face because it was one of those things I should have never sold, but just didn't know how long it was going to last and didn't want to, continue, paying the mortgage and all that good stuff. But the renter ended up buying it and got a good deal on it, and probably still in there today with a lot of equity.
They send you a Christmas card every year thanking you for their wealth.
They should. But yeah, no, I mean, that market's gone bananas because of things happening here in California. And it's not just California per se. It's happening everywhere, but California is definitely handing you a lot of wealthy buyers at the moment.
So Jeb, we got a second vote here. Brian Fox also piping in that he's going to vote Elder on September 14th. And
you're not going Kevin.
We got to go with Meet Kevin, right? Let's go with the YouTuber that he claims to be a Democrat, which makes him suspect. But my thing is, if you get Elder and everyone in the California State House is Democrat, they're probably just going to chase him around with pitchforks all day. What's he going to actually get done?
But you got to have you got a super majority at the moment. You got to break the super majority somewhere. And I don't care what side you're on. It's not a good thing to have one party running an entire state. It doesn't work.
No.
So it starts with it starts first with the recall, but secondly, it starts with getting somebody else in there that's not affiliated with that party, and everyone will benefit. Anyway, let's move along here because we don't talk politics. Let's see.
I found a vote for Meet Kevin.
I'm sure they're not hard to come by if you just stay on here.
So, I'm voting for him. I don't care. I'm voting for him. I hope he gets it.
Miami Vlad. We should actually have him on here. See if I can get him on to do a thing. He'll probably laugh at me since he's got like 2 million followers. Anyway, do you see rent prices rising and why? So we've discussed this a little bit. I think rent prices are going to continue to rise. You've got inflation playing into it, and whether or not you believe inflation's a real thing, you do have a lack of options out there, right? And when you have a lack of supply, and demand for rentals, you're going to have prices continue to go up. And I think a lot of, if the big hedge funds are investing in single family homes, then there's obviously something to be had there, right? We have a growing population. We have, people that are turning the age when they're moving out of homes, right? They got to get out of mom and dad's home at some point, and they can't afford to purchase because of where prices have gone. So the next best option is to rent. That's going to add demand, and I think in turn pushes prices up. Obviously, some areas are going to be a little crazier than others, but as a whole, you're going to see, rental prices are always going to rise. It's just a matter of how much and over what period of time, right? Prices now are higher than they were a couple of years ago, which were higher than they were years before that. So it's going to follow the trend of home prices. And eventually, you're going to be paying a lot more for rent.
And the affordable units, there's not affordable units coming online. We talked about this earlier in the show. What are builders wanting to build? Every one of those apartment complexes that has come online in the last 10 years in Huntington Beach are Class A, high-end rentals, like rentals that you're like, that's insane. Who would pay for that? The ones at Pacific City here, right across from the beach, if you want to be, 50 yards away from the ocean, you're going to pay through the nose. Like, what are they, Jeb? Like $4,000 a month for a one bedroom?
Yeah, something stupid, man. Like
Yeah.
the ones on the top are like $6,000 or $7,000. And this is like true apartment style living too, for the most part. You're paying top dollar, but yet they're rented. People are renting them. And what you can pay for $7,000 on a mortgage, come on, people. You could definitely find something in this environment. Josh just went dark again. Let's see.
I didn't pay the electric bill.
Just see. You got to move over. Let's see. Up, the boogeyman's back. So guys, if you're watching now, 206 of you, do me a favor, hit the like button if you find any value in the content. If you enjoy Josh and I being here answering your questions. We do this every Wednesday, but not next Wednesday because I'm gone, but most Wednesdays for 2 hours, guys. And time is money. So instead of money, we're like we get thumbs up. That's what we appreciate. So
you guys put thumbs up over in the comments if you want me to hijack the channel while Jeb's gone, and we'll talk about everything except for real estate next week.
To be too good. Yeah, hit a thumbs up if you want that. This thing will go down the tube quick.
You'll get banned. You'll be evicted from YouTube.
Yeah, I'll lose my channel. Anyway, so we got Michael just asked, can we get back to real estate? So I'm assuming that was 3 minutes ago. Have we been on a tangent that long? All right. Anyway, let's try to find some. Oh, he was probably talking about the politics. Let's see. Josh, if you see something, hit it, buddy. I don't.
No, again, it's all comments today. No one. Well, here we got one.
Yep.
H. Gray says, are you familiar with reverse mortgages? If so, have the same forbearance provisions been available as for other government-backed loans? Was the monthly accruing interest able to be paused during the moratorium? The answer is no, and there would be no benefit to doing so. So the vast majority of reverse mortgages are HECMs, home equity conversion mortgages. It's another program run by the FHA. So for those that took forbearance, I have a client right now, 12 months in forbearance, $52,000 tacked on to the end of their loan. Well, on your reverse mortgage, it's getting tacked onto your loan anyways. You're not required to make a monthly payment. That interest just accrues on the loan every month. So with the forbearance, no one was just waiving interest and saying, hey, you get to live there free for 3, 6, 9, 12 months. They were just not collecting it. And then when you start making your payments again, they're getting tacked on to the back end of the loan. And that's just naturally what happens with the reverse mortgage. You don't make payments, the interest accrues, it gets added to your loan balance. And someday you'll pay it off, or you'll pass away and your heirs will pay it off when they go to take over the home or sell the home.
All right, we got another question from Rose here. She asked, what is the actual deadline to have your down payment closing costs by? Is it okay if I have a paycheck a few days before closing to get the final amount? Josh?
I love, Rose has had a bunch of really good questions. These are basic fundamental questions, but they're questions that come up really often. So apparently we're not covering them enough. Other people in this space are not covering them enough, because people ask this question all the time. So you do not have to have your money into escrow until the day that we close. So I have a girl closing escrow tomorrow. She wired her funds today. She could have wired them tomorrow morning. The bigger question that we have here is we have to source those funds. So she doesn't even have them. It's not delivering them to escrow. Rose is saying, hey, if it comes in a paycheck on Wednesday and I'm closing on Friday, is that okay? The answer is yes. We just have to source and document it. So let's say in that example, Wednesday the paycheck hits. We need an activity printout, because I'm assuming that your bank statement doesn't magically print right after that, or come out after that. Your cycle is a little off from that. So we need an activity printout of all of the activity from the end of the last statement through that paycheck hitting, and then a copy of the paycheck so we can match it up and show what it is if it doesn't say who your employer is. A lot of payroll deposits will be clearly a payroll deposit, so we wouldn't need the paycheck. But worst case, we need the paycheck, we need the activity history, we need to get that in front of the underwriter so the underwriter can go, yes, you're good with that. Now, it's not quite as simple as that being on Wednesday and we're going to close on Friday and now it gets deposited, because you have a minimum required contribution. The underwriter ahead of time is going to have to have verified that you've met that to qualify for the loan, to get you clear to close and get docs sent out. So in real terms, I want to say 7 to more safely 10 days ahead of time, you would need to have your money lined up, just because the mechanics of getting the underwriter to review the file, marking your file clear to close, ordering your loan documents, getting your documents to escrow and getting them signed, that's probably the timeline that you're going to be looking at.
All right, there we go. Mario's got a question here. It's a good question. Is there a way to determine if a home is overpriced? The price per square foot, maybe the Redfin or Zillow estimate, or of the year-over-year change of greater than 15%? No, none of those. In fact, you can't use a price per square foot basis just because two homes have to be identical in square footage, in upgrades, in location, and all of that, in my opinion, to really use a price per square foot basis, right? New construction, maybe you can use that. An existing home, not really a measure of true value of a property. Now, I do use it sometimes when I've got multiple comparables and I'm trying to get to an idea of price. I kind of say, okay, this, and then I vary a little bit off that depending on the upgrades, location, or what have you. But the only way to truly tell whether a property is overvalued or not, outside of just waiting to see if somebody's willing to pay that price, is looking at other comparables in the market, not necessarily the price per square foot, but looking at a price, where it's sold, the location of it, the upgrades of it. Now, you might say, well, then you're looking at the price per square foot. I'm not really. I don't look at the price per square foot until I can't find something that is comparable of those properties, because you might have two properties that are similar in size and everything, but the price per square foot is completely off for one reason or another. And so it might get skewed if that's all you pay attention to. But if you have a good, knowledgeable agent, they can look at the numbers and kind of give you a direction of where things are going. The problem with Zestimates and all of that stuff is that, again, it's all AI. It's all, they're using different methods to pull these, and there's not a person behind a lot of these numbers out there, right? It's just, again, artificial intelligence using different algorithms to figure out values. And so you can't really use that as well. And then the 15% year over year change. I mean, some markets went over 25% last year. So that's not really fair either. I would say the only real way is to have a realtor look at the comparables and give you numbers based on that. And even sometimes that is hard to do just based on what is sold and depending on the area and what there is to compare it to in that market. But that's my thought on that. I don't use price per square foot unless I can't find anything else, and then I kind of work backwards from there to give you an idea of value when I'm talking about things.
Jeb, my house is one of the best examples for why you don't use price per square foot. In my neighborhood, there's 4 models. Tract homes, so there's actually a 5th, but there was very few of them built. So for the most part, repeats of 4 models. Mine is the smallest. all of our lot sizes are exactly the same. In California, the vast majority of the value of that property is in the lot. So mine's a single story home, it has a 3-car garage. There are not very many of those in Huntington Beach, California. There was actually 2 tracts built that way and a couple of other tracts where a lot of people have added the 3rd-car garage to their single story. So because of that, we get a monstrous price per square foot relative to my neighbors who have homes 500, 600, 700 square feet bigger, especially the unfortunate souls in a 2-story house with a 2-car garage that no one wants. So there's other factors that come into play. And if you're in a state like California where there's so much value in the land versus the property, the price per square foot can easily be skewed.
Absolutely. Yeah. I mean, I sold a single level in my neighborhood recently. If you looked at a price per square foot basis, you would have thought, man, that thing is overpriced. But yet it was a single level, been completely upgraded, and it sold within days for, above the asking price with a free 6-month rent back. So again, there are definitely instances when the price per square foot is thrown out, and that's why you shouldn't use it. So good example there, Josh. I didn't even think to throw that one in there. A couple more questions here, I think that are worth or that are great questions and we should address. They don't really come up that often. Michelle's asking, what does the appeal process look like for an appraisal that comes in short?
Depends on the type of loan. Michelle's looking at conventional loans, so let's focus on that one in this situation. Every appraisal management company or appraisal desk has basically their rebuttal form. And what you're doing is you're spelling out the details of that appraisal that you think are incorrect. Did they omit better comparable sales? Did they make inaccurate adjustments? Did they mismeasure the house? Did they say it's 1,700 square feet and it's 2,100 square feet? We have to find a factual basis for rebutting that value. We can't simply state we think it's worth more, or there were 22 offers on this property. No matter how many offers are on a home and no matter how high those come in, there still have to be comparable sales to support that value. Or it's likely to come in short. So really that process is as simple as we get with your agent and potentially the listing agent, and we put our heads together and we pull every property that we think might be a better comparable sale. We look through that report and say, did they overlook anything? Did they omit anything? Are there mistakes? Are there judgment calls in there that we don't agree with? So the reality is, I'm going to say, especially in the current market, 10-15% of them get any adjustment on the rebuttal. The vast majority of them come back and the appraiser goes, hey, thanks for playing. We're going to stick with our value.
All right. Got another question here that just came in from Kay Larth, who I know follows the channel and supports and always asks a lot of questions. Do you think forbearance will be extended? I don't think so. I think at this point we've reached the end of forbearance unless something happens where there's a complete lockdown again. I don't see that being the case. The moratoriums and that sort of thing on evictions and foreclosures, now that could be a different story. Hard to say the direction that that's going at the moment. But I don't think forbearance will be extended. And earlier you asked a question about another channel asking if I watch it and the data and all that stuff. I've seen the channel. I don't follow it. I have a hard time following any channel that every single time they post anything talks about a crash. I hate talking about it because I don't believe there's one. And therefore it's hard for me to follow anybody that is their whole idea of their channel. So hopefully that addresses your question there. Another question. Josh, do you want to go on that, Josh, or no?
I was just going to say that you only have time to watch TMZ and ridiculousness, so there's not enough time left over for things like other people's YouTube channels.
I don't know what ridiculousness is, and I almost said THC.
THC, yeah.
TMZ. Haven't watched that in quite some time.
Yeah.
Let's see here. I'm self-employed. Prop Schedule C for a bank statement loan. If I consistently transfer small amounts from my biz account to my personal, do I need to show 12 to 24 months of statements from both accounts?
Generally, they're only going to look at one or the other because you just end up commingling amounts. So an amount that gets deposited to your business account, the fact that it goes over to your personal, it was already your business. So we can't count it twice. so the only way we would really go into it if you end up with mixed, a husband and wife. Wife has a W-2 job, husband has self-employment, and we're doing bank statements for his. We might have to pull the personal bank statements to show the deposits of the payroll and back those out. So no, for the most part, you're only going to use either the personal or the business, and it really depends on how you handle the distributions to yourself from the account.
All right. And I forgot to mention earlier when we started this, guys, we're going to have to turn
the lights off.
We're gonna have to turn the lights off a little bit early tonight, just because I have got to pick up my son from soccer. So we got about 5 more minutes here, and then we're going to call it a night. So I know that's a little bit earlier than normal, but we'll do as much as we can, as quick as we can before then. So Sam has a question here: are conventional loans still preferred over FHA loans? What I will say is that most sellers prefer the highest price, first off. Second thing they look at typically is down payment. This is from experience. Now, this isn't going to be every seller across the board. So in the case that, you're both offering the same price, I would say that conventional loans are generally preferred more than FHA, but it comes down to price first. So it's one of those things. I've talked about videos in more detail on this, and it's something that could go even further down, but in lieu of answering more questions here, or in lieu of going down that rabbit hole and answering more questions, let's answer more questions just so we can help more people. Let's see, Josh.
We've got, this has popped up. I don't know if it's the same person asking it multiple times, but 40-year loan coming. The answer is no. Under the qualified mortgage guidelines, anything longer than 30 years is not allowed. The vast majority of lenders want to make QM loans so that they can have some protections against lawsuits from borrowers. So if they were to come back, it's going to be a non-QM loan. It's going to be at higher terms, which is going to mitigate the benefit of going out to 40 years. And there's a reason why 30-year loans are the most common. It's the sweet spot. It's bang for your buck in terms of keeping the payment to a minimum without stretching that loan out to a longer timeline. So it's not our place to say that they're a totally inappropriate tool, but under the current legal framework, they don't meet the qualified mortgage guidelines, so they're always going to be a fringe product if anyone does them.
All right. I'm going to address this question because I can make it real quick. What's your take on a market crash? I don't believe there is one. Joey Crack asks, how bad is the process for buying a house in short sale? It depends, right? I haven't come across a short sale in a long time. Towards the end of the last debacle in the housing market, the banks had it pretty streamlined with regards to handling short sales. I don't know where they are in the process at the moment with regards to them. So it's hard to say, but typically speaking, they take longer. You're not going to be able to do a 30-day escrow. It's going to take, some working with both parties in order to facilitate these. Normally they're a complete pain in the butt. Even when they were streamlined, they were still a pain. I don't know how they are in this market. We haven't really come across a lot of them. And I don't think we are going to for any period of time, just because of the amount of equity that people have in their properties.
And if you remember, Jeb, the big thing towards the end of it, agents were advertising pre-approved short sale, meaning that the bank had already agreed to a dollar amount. So if you, the buyer, were willing to pay that dollar amount, it was in theory a streamlined process. But even at that, most times the bank had pre-approved a number that was more than what most buyers would want to pay. So there was still a negotiation with the bank as to whether they would accept what a buyer was actually willing to pay on the property.
And understand that banks know the supply and demand at the moment, right? So if you do have a short sale, they know that they can get top dollar for that property. So the chances of you getting a deal in this market, probably not going to happen. So I would tell you, if you have an opportunity to buy a short sale or buy an existing home, you probably want to go with the existing for just the headache alone, or avoiding the headache alone, because chances are you're not going to get, there's not going to be much of a benefit to going through the short sale process. Josh, we're reaching that 6:40 time frame here. Again, I'm going to ask a favor, guys. If you're watching, hit that like button, that thumbs up there at the bottom. It helps more people see it. It helps us accomplish our goal. That little thing right there, you can't see it on Josh's shirt because his shirt is like
camo.
A floral camouflage. So if you despise Josh's shirt and you like the thumbs up, hit that. instead. If not, just punch. If there was like a punch, like we like get a fist on there where you could just repeatedly like punch us, that'd be awesome. Like like a bobblehead. My head would probably go like this the entire time when I talk, because people think I'm an idiot. But nevertheless, Josh, anything final you want to add to this?
No, it's, we've kind of hit a stretch of the year where things are a little bit more normal. It's busy, lots of buyers still, but not as hectic as it was. Value still going up, as you said, multiple offers on desirable homes that are priced appropriately. So it is what it is, but come back, show up with your questions. We'll be happy to answer them. If either of us can help, we're always available by phone and email. And if you're outside of California, as Jeb always says, we have a big network of real estate and mortgage professionals to connect you with.
Yeah, absolutely. As I mentioned at the beginning, not here next week, taking a week off for some family vacation before the school starts. The school year starts here in Southern California. So going to give you guys some time away to think of some really good questions for the week. But if you're watching this after the fact, if you have questions, put them below. We'll start off next live by addressing those. But if you have questions for me, for Josh, our emails are there. We do appreciate you taking the time to watch. We appreciate all the support. Hit that like button. We'll see you again. Adios, my friends. Bye-bye.